All right, this is part 2 of chapter 10. In this chapter, we're going to basically discuss natural resources and your intangible assets, as well as financial reporting for long-term assets, both fixed and intangible, and then some financial analysis. Natural resources. Some businesses do own natural resources, and these are including anything from like timber to minerals and most obvious oil. The characteristics of natural resources are as following. Of course, there's naturally occurring. They can be removed for sale and removed and sold over more than 1 year. So natural resources are classified as a type of fixed asset. So the cost of natural resources includes the cost of obtaining and preparing it for use. So an example, legal fees incurred in purchasing a natural resource are included as part of its cost. As natural resources are harvested or mined and then sold, a portion of their cost is debited to an expense account called the depletion expense. So depletion is determined as following. So the depletion rate equals the cost of the resource divided by the estimated total units of resource. So to get the depletion expense, you then take the depletion rate times the quantity removed. And that's how you would be able to know how much to record in your depletion expense. So let's illustrate that Karst Company purchased mining rights. So the cost of the mineral deposit was 400,000. Estimated total units of resource is about 1 million tons. And the tons mined during the year is about 90,000. So the depletion expense of 36,000 for the year is computed as follows. So basically what you're going to do is you're going to take the cost of the resource, which was 400,000, divide it by the total estimated units, which is about 1 million tons. So that's going to be 40 cents per ton. So to get the depletion expense, you're going to take that 40 cents per ton times the total amounts quantity removed. So remember, you take the depletion rate and you multiply it by the quantity removed. So again, let's repeat that. To come up with the depletion expense that you're going to record, you first calculate the depletion rate, which is your cost of the resource. The cost of the mineral mine was 400,000, divided by the estimated total units of resource. So they're estimating there's about 1 million tons in that mineral mine that can be used, okay, removed. So you're going to take that 400,000 and you're going to divide it by that estimated total amount of resources. Okay, and that's going to give you your per ton amount. So it's 40 cents per ton. Now, during the year, they mined a total of 90,000 tons. So to get the total depletion expense, you're going to take that depletion rate of 40 cents per ton and multiply it by 90,000 tons. And that gives you a depletion expense of $36,000. So here's how the journal entry would look. So you would go ahead and expense out the depletion of the natural resource. And then, of course, you're going to offset it with your accumulative depreciation contra asset account. So like the accumulated depreciation account, accumulated depletion is a contra asset account. It's reported on the balance sheet as a deduction from the cost of the mineral deposit. So the cost of the mineral deposit is your asset. So you would, on your balance sheet, show the mineral deposit of $400,000 as an asset, and then the accumulated depletion contra asset of 36,000 would show to reduce the value of that asset, just like you do on machinery and equipment. Let's do an example. Earth's Treasure Mining Company acquired mineral rights for $45 million. The mineral deposits there is estimated to be about 50 million tons. So during the year, 12,600,000 tons were mined and sold. So first we have to calculate the depletion rate. So the depletion rate is going to be the cost for acquiring it divided by the total estimated resources available. So you're going to be basically going to take 45 million and divide it by 50 million. And your answer is going to be 90 cents per ton. That is your depletion rate. So again, we take the cost, which is 45 million, divide it by the total amount of minerals that should be available to be removed, which is estimated. It's an estimate, of course, of 50 million tons. So you're going to take that $45 million, divide it by 50 million tons, and you get a depletion rate of 90 cents per ton. Now, they want you to determine what the depletion expense for the current year. So in the current year, they removed 12,600,000 tons. So you're going to take that depletion rate and multiply it by the total amount that was mined and sold during the year. So 12,600,000 times 90 cents is a depletion expense of 11,340,000. Now we're going to journalize that entry. And just like we showed up here, you're going to hit a depletion expense account and your accumulated depletion contra asset account. And this is what the journal entry would look like. All right, well, that is it for natural resources. Now we're going to move on to intangible assets. Most of what we talked about at this point is a tangible asset. Tangible asset is something you can see, touch, feel. Intangible assets are different. So the long-term assets that are used in operations of a business that do not exist physically, that's what is called an intangible asset. They do not exist physically. And they could be acquired through innovative, creative activities or through the purchase of the rights from another company. So some examples of intangible assets would be patents, copyrights, trademarks, and Goodwill. So the accounting for intangible assets are very similar to that of the fixed assets, but there are a couple of major issues. One, determining the initial cost, and two, determining the amortization, which is the amount of cost to transfer to expense. So let's first talk about patents. So manufacturers acquire exclusive rights to produce and sell goods with one or more unique features, and such rights are granted by patents. That's a federally, that's usually something that's granted by the government to inventors. An interesting fact about patents, the government loves to hire engineers to work in the patent office because then they basically go over, when you invent something, you submit a patent to the government for approval. And if it is then patented, you own the rights to that invention. And they hire, and so the government hires engineers to review these patent requests to, I guess, ensure legitimacy. But I thought that was very interesting. I never knew that was an interesting career for engineers that have masters, possibly even doctorate degrees. So the initial cost. So let's go back to off the tangent. So a business may purchase patent rights from others, or it may obtain patents deployed by its own research and development. So the initial cost of a purchased patent, does include legal fees, and it is debited to an asset account. So it is considered an asset. This cost is written off or amortized. That's not going to be a word I can say easily. Amortized over the years of the patent's expected useful life. Now, most rights continue in effect for about 20 years. So I think most patents have, a life of about 20 years. The expected useful life of a patent may be less than its legal life. So legal life is about 20 years, I believe. And then the useful life of a patent could be up to or less than 20 years. So an example, a patent may become worthless due to changing technology or consumer tastes. So obviously in today's technology, there are things that are going to always be coming up that's going to make one, invention useless because new technologies come out that's completely just blew it out of the water. So patent amortization is normally computed using the straight line method of depreciation. And the amortization is recorded by debiting an amortization expense account and then crediting the patent account. So a separate contract asset account is usually not used for intangible assets. Like we use the accumulative depreciation to record the credit. So in this situation, we are actually just recording a credit to the patent account. So let's look at an example. So assume that at the beginning of its fiscal year, a company acquires patent rights for $100,000. Although the patent will not expire for 14 years, its remaining useful life is estimated about 5 years, probably due to ever-changing technology. So the adjusting entry to amortize the patent at the end of the year is as follows. So obviously, you're going to take the $100,000 and divide it by 5, and that is how much you will record as the amortization expense. Now, some companies develop their own patents through research and development. In such cases, any research and development costs are usually recorded as an operating expense. And it's in the period in which they are incurred. This accounting for research and development cost is justified on the basis that any future benefits from current research and development are highly uncertain. So now let's talk about copyrights and trademarks. So the exclusive right to publish and sell literacy, artistic, or musical composition is granted by a copyright. And copyrights are issued by the federal government, and they actually can have a legal life of about 70 years beyond the author's death. So the costs of a copyright include all costs of creating the work plus any other costs that you obtain while obtaining the copyright. So a copyright that is purchased is recorded at the price paid for it. So copyrights are also amortized over their estimated useful lives. Trademarks. Now, like the golden arches of McDonald's, that's an example of a trademark. And a trademark is a name, term, or symbol used to identify a business and its products. Under federal law, businesses can obtain their trademarks by registering them for 10 years and then renewing their registration for 10-year periods. So every 10 years, you basically renew your registration for that ownership of that trademark. So like a copyright, the legal costs of registering a trademark are recorded as an asset. Most businesses identify their registered trademarks with the little circle with R in it in their advertisements and on their products. And that's to let you know that, hey, that's our trademark. If a trademark is purchased from another business, its cost is recorded as an asset. And in such cases, the cost of the trademark is considered to have an indefinite useful life. So trademarks are not amortized. Instead, trademarks are renewed periodically, like every other 10 years for impaired value. So when a trademark is impaired, the trademark should be written down and a loss recognized. All right, let's talk about goodwill. What is goodwill? So on a balance sheet, McDonald's will reported goodwill of like $2.9 billion. Right. So, and most of McDonald's goodwill arises when it purchases existing restaurants from franchise. So goodwill, what is that? What does that mean? It refers to an intangible asset of a business that is created from such favorable factors as location, product quality, reputation, managerial skill. Goodwill allows a business to earn a greater rate of return than normal. So GAAP allows goodwill to be recorded only if it is objectively determined by a transaction. An example of such a transaction is the purchase of a business at a price in excess of the fair value of its net assets. So the excess is recorded as goodwill and reported as an intangible asset. So McDonald's compares fair value to book carrying value to determine whether goodwill is impaired. So unlike patents and copyrights, goodwill is not amortized. However, a loss should be recorded if the future prospects of the purchase firm become impaired. So the loss would normally be disclosed in the other expense section of the income statement. And below is just an example of a journal entry. So assuming that on December 31st, Face Card Company has determined that $250,000 of the goodwill created from the purchase of electronic systems is now impaired. So then this would be the journal entry to show the impairment of the goodwill. So real quickly, we'll just do a quick comparison of the intangible assets. You have patents, copyrights, trademarks, and goodwill. Description: a patent is an exclusive right to benefit from an innovation. Copyright is an exclusive right to benefit from a literary, artistic, or musical composition. Trademark, exclusive use of a name, term, or symbol. And goodwill, excess of purchase price of a business over the fair value of its net asset. Okay. All right. So you can read on it, what is the different amortization periods. So both with patent and copyright is based on its estimated useful life, and it's not to exceed its legal life. And then neither a trademark nor goodwill are amortized. And then, of course, with patents and copyrights, the periodic expense is the amortization expense. With trademark, impairment loss if fair value is less than the carrying value for both trademark and goodwill. Now, financial reporting for these long-term assets, both fixed and intangible. On the income statement, you have depreciation and the amortization expense should be reported separately or disclosed in a note. A description of the methods used in computing the depreciation should also be reported. On the balance sheet, each class of fixed assets should be disclosed on the face of the statement along with its related accumulated depreciation. So really quickly, if you look right here, fixed assets, some balance sheets actually will title this fixed assets. Some balance sheets do actually title it property, plant, and equipment. But here is where your fixed assets, both tangible and intangible, should be listed. So a lot of times, but they should be all listed out separately. And with all of the fixed assets, you should also show yeah, they do the tangible assets separately. So a lot of times in balance sheets that I've seen in the past, you'll see like a category that says fixed assets, and under the fixed assets, they'll put property, plant, and equipment, and then they'll put the intangible assets separately. Yes, they did do that. So, but you should also have the fixed assets with their related cumulative depreciation shown, decreasing the value of those fixed assets. So, and the intangible assets are usually reported on the balance sheet in a separate section following the fixed assets, and the balance of the class of intangible assets should be disclosed net of any amortizations. So if a company has natural resources, depletion expense is reported on the income statement. And in addition, the cost and related accumulated depletion of the natural resources are reported as a part of the property, plant, and equipment. So here, if you had natural resources, it would be in this section right here. And then you would see the accumulative depletion contra asset account. So let's talk about some financial analysis interpretation. So we have what's called a fixed asset turnover ratio. This measures the number of sales earned per dollar of fixed assets. So the higher the ratio, the more efficiently a company is using its fixed assets and generating revenue. So this is how you compute. So basically you have your total sales and you divide it by the average book value of the fixed asset itself. So here, they're using an example of McDonald's Corporation. So their total sales was 25, this is probably in the millions, to be honest with you, 25 million 413. Then you have your fixed assets. So it says your average book value. So again, every time we do an average of anything, it means taking the beginning of the year balance plus the end of the year balance and then dividing it by 2. And that gives you your average. So here they gave us the beginning balance and the ending balance of their fixed assets net value. So net value means obviously the accumulative depreciation has already been reduced out of it. So McDonald's fixed asset turnover ratio for the year is computed as follows. So their total sales divided by their average book value equals a 1.1 ratio. So now the question is 1.1 efficient? To answer this question, McDonald's fixed asset turnover ratio can be compared to other quick service restaurant companies such as KFC, Pizza Hut, Taco Bell, etc. So down here, we compare them and they're actually pretty low. Because if you remember here, it says the higher the ratio, the more efficiently a company is using its fixed assets. So if we look here in comparison to other fast food services, they're actually the lowest. So differences in the fixed asset turnover between these companies can be due to a number of factors, including differences in both the average fixed asset book value and the sales per restaurant. So explaining McDonald's low fixed asset turnover ratio relative to the other restaurants would require deeper analysis into the variables. So comparing companies within industries is useful because, the fixed asset turnover ratio could be comparable within an industry. The fixed asset turnover ratio will vary across industries because of differences in how industries are use their fixed assets. So another example is the fixed asset turnover ratio for selected companies in different industries. So obviously, none of these are all comparable industries. These are not comparable industries. And you can see vast differences in their asset turnover ratio. So it does the smaller fixed asset turnover ratios are associated with industries that require large fixed asset investments to generate revenues. The larger fixed asset turnover ratios are usually associated with industries that require smaller fixed asset investments to generate revenues. In simpler terms, like if you have to purchase and run large pieces of equipment to generate your product, then obviously you're going to have a higher investment into your fixed assets versus a company that does not have to purchase large pieces of equipment to produce their product. That's basically what that's saying. So let's go ahead and do this example right here at the bottom. All right, so the financial statement data for years ending in December 31st for the Broadway company as follows. So it gives us year 1 and year 2 total revenue, and then it does give us the beginning year and ending year book value of their fixed assets. So in A, it says determine the fixed asset turnover ratio for year 1 and year 2. So the first things you're going to have to do is, of course, get your averages, which is adding these two totals together. So for year 1, you'll add these together and divide by 2, and it gives you your averaged fixed assets. And the same thing here for year 2, you're going to take the beginning and the ending, add together and divide by 2 to get your average fixed assets.